On Friday, May 2026, the East Room of the White House is packed with the architects of the global financial system. The room is thick with the specific tension that accompanies a transition at the world's most influential central bank. Supreme Court Justice Clarence Thomas administers the oath of office. With these words, Kevin Warsh assumes leadership of the Federal Reserve. He is now responsible for the institution that issues the world's reserve currency and regulates the cost of borrowing for billions of people. Standing right beside him is the president. Donald Trump tells the gathered audience with total confidence that interest rates will come down very quickly. But the man taking the oath is inheriting an economy where inflation has just re-accelerated to 3.8%, and consumer sentiment has hit a record low. These figures suggest that the rapid rate cuts the president is demanding would likely trigger a further surge in prices. The Federal Reserve now faces a direct clash between the president's political promises and the mathematical requirements of price stability. To understand the weight of this moment, you have to look at what the Fed chair actually influences. Kevin Warsh sets the federal funds rate, the price at which banks lend to each other. This single number determines whether a family faces a 7% mortgage or carries the compounding burden of a 21% consumer credit card. The consequences cascade outward to the rest of the world. Because the dollar is the global reserve currency, this baseline rate dictates the cost of debt for developing nations. When rates stay high in Washington, it becomes significantly more expensive for governments from Zambia to Indonesia to service their loans. The economic landscape has shifted. He was selected to oversee a period of low inflation and AI-driven growth. But a sudden energy shock in the Middle East has driven up fuel costs, reversing the downward trend in inflation. Warsh arrived with a mandate to cut rates to fuel a boom. The current data, however, points toward maintaining or even increasing those rates to prevent prices from spiraling. After cooling, consumer prices in May 2026 re-accelerated to 3.8%, nearly double the 2% target. Simultaneously, high fuel and food prices pushed the Consumer Sentiment Index to a record low, 49.8, indicating a public feeling the direct impact. In previous decades, the government might use deficit spending to stimulate the economy, but with national debt at $39 trillion and interest payments reaching $1 trillion a year, the high cost of borrowing has significantly narrowed the government's ability to spend its way out of a slowdown. With high inflation, record low sentiment, and a massive debt burden, the traditional tools for economic relief are currently obstructed. These conditions have placed the economy in a stagflationary trap. This occurs when the economy's growth slows down while the cost of living continues to rise. Each policy option carries a heavy cost. Cutting rates to encourage growth risks signaling to the market that the Fed has given up, which could cause prices to stay high for years. Conversely, holding rates at their current levels to lower inflation keeps borrowing costs high for a public already struggling to pay for housing and daily expenses. Wall Street investors are waiting for the rate cuts the president promised. However, the economic metrics on Warsh's desk suggest that such a move could undermine the currency's value. This stagflationary cycle forces the Federal Reserve to choose between two outcomes that both involve significant public hardship. The June 2026 Federal Open Market Committee meeting will be the first major test of the Fed's institutional independence. The board must decide whether to follow the president's public demands or the internal economic data. The Fed relies on the belief that it will prioritize price stability over political pressure. If global bond markets decide that the new chair is acting on a presidential directive rather than economic analysis, the institution's credibility collapses. History shows the cost of losing that trust. In the early 1980s, Paul Volcker had to raise interest rates to 20% to correct the inflation that had spiraled out of control. That correction required a deep recession to restore the dollar's value. Kevin Warsh has studied Volcker's era extensively. He understands the long-term consequences of prioritizing short-term political approval over difficult economic discipline. Caving to political pressure would provide temporary relief and satisfy the president's promises, but it risks a decade of high inflation that would erode an entire generation's savings. Holding the line means accepting high interest rates and continued financial strain for households today. While painful, it is the only path that historically leads back to a stable, predictable economy. The future of the global economy now depends on whether the individual leading the Federal Reserve chooses to maintain institutional independence or yield to the political pressure of the moment.